Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, Mr. Michael Becker, smartest guy in the room. Well, hopefully, maybe the second smartest guy in the room. We're hoping that our guest is the smartest guy in the room, at least when it comes to this conversation. Michael, how are you?
Good. Just staring at my signed ball from Pudge Rodriguez from the Old Capital Conference. So that was something to see, huh?
Yeah, we had Pudge Rodriguez out there and listening to his Hall of Fame career, just unbelievable. In fact, I was reflecting just recently on him being part of that Robin Ventura and Nolan Ryan scuffle. That's a real famous picture of Nolan Ryan pounding Robin Ventura. And then Pudge Rodriguez was the catcher in that deal too. So he talked a little bit about that famous picture, the famous fight. Very interesting. And then we also had wonderful speaker in the form of the president of H-E-B grocery stores. They're one of the largest grocery stores in the country. They're really focused in on Texas. They do about $34 billion a year in sales. In some of these areas, Michael, and you can tell, what kind of market share does that company have?
Yeah, I think they're saying in some of these markets, they're having upwards of like 80% market share, and that's competing against like Walmart, for example. And I think, what did he say? Like in Austin and San Antonio, they're something like 60-70% of the market in those two major cities. Is absolutely unbelievable.
Yeah, unbelievable culture at H-E-B. Again, some people have never heard of them. They're probably not coming to a state that you're from if you're outside the state of Texas, but they do. They're privately held, and they do an unbelievable job with 120,000 employees. So we talked to Scott McClellan, who is the president, and he just gave us some interesting advice of how to manage not just 120,000 employees, but how do we manage 4 or 5, 6 employees. And so he was great with some nuggets of helping people understand how to manage and set expectations correctly for folks. Anything more, Michael?
Yeah, it's just sad that back to Pudge, that the baseball team here is so pitiful that the most famous and popular historical event was an old man punching a punk. And that was kind of a sad state of our Texas baseball, I guess.
And that was 25 years ago, too. Unbelievable. 30 years ago almost. Crazy times, but we're very
Speaking of bad sports, I guess, huh? From a Philly sports fan, right? Is that right, JP?
Easy. I didn't know I was going to get blindsided right out of the gate.
So the guest today is JP Conklin, who's one of our friends. And, we kind of call him the interest rate guy. He kind of helps us figure out where interest rates are going. And Michael and I really wanted to have a little bit more of an in-depth conversation with JP. This is because we've seen the 10-year Treasury rise. And as Michael will tell you, and I will tell you that we've been pounding the table a little bit about doing adjustable rates for the last couple of years. We were kind of talking about fixed rates for the last 10 or 15 years prior to that. And we kind of changed our perspective to try to do adjustable rates just because a couple of things. Rates were low and we're going to continue to be low. And that yield maintenance penalty that came with the fixed rate, the cost of selling your property, paying off the loan that prepayment penalty was just huge. And it wasn't, $10,000, but it could be in some cases $500,000 or $2 or $3 million to pay off. That's the kiss goodbye to
my largest one was $6.5 million. So there you go.
But Michael, tell us about that story a little bit, because $6.5 million again. Why did you have to pay that just to say goodbye or pay off that loan?
Because we got trapped. It was a slow motion death when we got awarded a deal in October of 2016, and we didn't get rate locked until December of 2016. In the middle of that, Trump got elected, and the rates just ran on us. And so it was just every day, little slow motion death got a little worse every single day until we finally locked. And then of course rates went down, shortly thereafter that. But so it's just kind of the inverse. So the lender who has the bondholder owns the mortgage, ultimately, I guess, wants an income stream. So if your rates are lower today than when you fix the rate on the loan, they have to go replace that income stream with lower interest rate environments. So they have to buy more bonds to account for that. So basically, that's the death trap I found myself in a few times. But so yeah, we've been kind of team float for life. So I guess maybe we can bring JP on. So JP, maybe JP is the president of Pinsford, which is a interest rate hedging company. Maybe JP, I know we've had you on several times. Maybe get the short version on who you are and kind of what you do. We can get into state of the market with interest rates.
Yeah, thanks for having me back. Always love to be here. Wish it was following an Eagles surprise victory over the Cowboys. It was not, and it wasn't even close. That was pretty painful. I caught a lot of flack from our Dallas clients. I've been in the interest rate derivative business for about 20 years now, and I started off at one of the major banks and kind of worked my way up there, and eventually left in 2009 to start my own company and basically switch sides of the table and come over and represent commercial real estate borrowers in their negotiation with banks around interest rates and interest rate derivatives. So commonly that involves an interest rate cap or a swap, or like Michael, you were talking about, defeasance calculations.
Yep. Well, good. So what's and if you guys don't already do it, the JP writes a very entertaining newsletter and has an audio version of that newsletter with his podcast. It comes out Monday morning. So I always look forward to that. It's the Rate Guy podcast. You can find that on probably any place you're hearing a voice right now. Just type that in. You can find it. And if you just go to pinsford.com, you can sign up for the newsletter there. Is that right?
Absolutely.
So I'd encourage that. So with all that said, what's going on? Yeah, Paul mentioned that here we are. We're seeing the talks of the taper is going to be around the corner. We are seeing the 10-year Treasury move up 30 or so basis points in the recent weeks. What's your take on it? Because you've been a Mr. Float for life for a while. We still float? I guess it's probably what your time horizon is, but what's kind of going on out there?
Yeah, sure. Lots of stuff bundled up into one question there.
Maybe just take it what's your take of the market right now? Like what are you seeing, and kind of what's your crystal ball say?
Let's start with the 10-year Treasury, because that's the one that's popped up recently that most people care about, right? I think it was 3 weeks ago in my newsletter and podcast, we talked about how inflation fears are too high, but the 10-year Treasury yield is too low. And that what was holding the 10-year Treasury yield down was Delta. That's it, right? This Delta surge had caught the market off guard. And so we saw rates start plunging as Delta started to spread its wings, and the market said, oh, no, are we kind of doing this over again? And so we saw a quick 30, 40 basis point drop, mostly because the market had to start pricing in some probability of a repeat of last year. But this year is totally different. I think, number one, we know far more than we did 18 months ago. I think that there's probably some fatigue around it and people just refusing to do certain things. We have vaccination. I think adults are somewhere in the neighborhood of like 60-65% of all adults in the United States are vaccinated. And it just seems like it's a different animal this time around. And so I wasn't buying that Delta was going to cause, if it continued to do what it was doing, right? It seemed to be more contagious, not necessarily more deadly. And so I just thought, this is going to peak in the next couple of weeks. And if assuming that's correct, the market will start to back that out. It'll back this depression out, and we'll see the 10-year spike back up to 150, maybe high end 175. And I think we're starting to see that, right? The catalyst in part was last week's Fed meeting, where the Fed was maybe more hawkish than people had expected. And I don't know if you guys saw it, but that week's newsletter, what we talked about was I was concerned that the takeaway from the Fed meeting was going to be the Fed now projects a rate hike in 2022. Right? And that was exactly what ended up happening. But that's based on a false premise, because the Fed puts out these anonymous forecasts for Fed funds at these meetings, but they don't put their names beside it. And not all forecasts are created equally. I care about Jerome Powell's forecast way more than I care about somebody else's. But we don't know what his forecast is. We just know he's pretty dovish in the grand scheme of things.
Yep.
So they came out. They have 9 out of 18 FOMC members now think that there will be a hike in December of 2022. And that's why the headlines read, Fed now forecasts the hike. Even though they didn't actually reach an agreement, they didn't have a discussion about it. It was just the conclusion taken from this. And Jay Powell hates these things. He has said, like, I can't stand these dots. You should not read too much into these, but they keep putting it out. It's crazy. So here's what happened. The front end of the curve jumped because that's what's most closely tied to the Fed funds, right? If the Fed is going to hike, the 2-year Treasury is going to move with it, right? And then the 10-year Treasury, coupled with some sort of relief on the COVID front, now had room to run back up to 1.5, right? And in part because what the Fed said was inflation has been higher than we thought it was going to be, and it's lasted longer than we thought it was going to be. Even though our general thesis is the same, that inflation is transient and is going to come back down next year. But the market interpreted that as, hey, it's caught them off guard a little bit. If they were wrong then, they might be wrong next year. We've got to extrapolate that, and rates popped up across the curve. So that's kind of a quick summary of why we've seen rates pop over the last week or so.
And do you think you still kind of have the thought that we probably have a ceiling somewhere around 175? Is that kind of where you think this is in the short run, the worst case?
Yeah, and to get to 175 is probably 3 years. That's not going to happen anytime soon. If you look at the Fed's own forecast when they're making these projections, year end 2023 is still 1%. So it's not as if they're projecting this runaway freight train. And this is, you guys said, hey, are you no longer a fan of floating if the time horizon is short enough? And I would say no. If anything, I'm more a fan of floating because as rates have popped, that means you have to pay a higher premium to lock. Yep. And if your time frame is 3 to 5 years, you're probably still looking at sub 2%. And that's even if everything comes to pass, which I'm skeptical of. I think it'll be less than that. So no, I still think that if you look at market expectations and what the Fed is saying, you go out 3 years from now and you kind of look at the end of 2024, the market's got LIBOR below 1.5%. This is not a runaway freight train.
Yep. One of the things that you see these headline CPI numbers, and a big percentage of CPI is owner equivalent rent, which is some made up stat, the best I can tell, because actual rent being a landlord is, running away. I mean, we're seeing mid-teens kind of trade outs on new leases over the old leases pretty much across the board, pretty much across the entire country, somewhere near double digits. And owner equivalent rent is, as stated in CPI, well below what reality is. I mean, I would assume that we would see some big pop in CPI in the next few prints just due to the rent. Even with that, you still think that it'll be gradual and slow and not run away?
Yeah, absolutely. Because there is very real inflation, but it is in pockets of the economy, not the entire economy. And those pockets are usually most closely correlated with leverage because interest rates are at zero, or in things that have experienced dislocations in supply chains. If you take those out, it's not as if the general overall economy is overheating, right? And we're even seeing like used car sales are already cooling off where they had peaked in sort of July. So it's already starting to happen in certain places. And one of the things I always like to point out to people who are worried about the Fed hiking dramatically is the Fed hiking dramatically is not going to solve supply chain dislocations. So sure. It would be pulling one lever to fix something that's not connected to that lever whatsoever. So that's not going to be their MO this time around. What they're after is the overall economy overheating too much? And the answer is really no. We've just got these weird pockets. Those of us in commercial real estate feel it more acutely than most. So it feels more painful to us. But if you go talk to a minimum wage person, they're probably not feeling it the same way that the rest of us are feeling.
Yep. Got it. Paul, what are you seeing?
Well, we had Casey Conway at our event last week, and he was talking about inflation. I really see the 10-year Treasury as a reflection, almost a mirror of inflation. And things that directly impact us are just have huge rises in inflation, whether it's paint or materials. I mean, Mike, you're seeing that right now on some of your properties. I mean, where we were projecting maybe $3,000 or $4,000 or $5,000 a door when you do a rehab or a turn, if you're updating the property, it's $6,000, $7,000. I mean, what are you seeing out there? And getting back to inflation, Michael?
Yeah, I mean, labor, materials, like a lot of the supply chains, like paint is dislocated, appliances, et cetera. All those are kind of dislocated. So we're seeing some of that. Hopefully, it's kind of improving and cleaning up a little bit. So like I would probably concur with JP that it's a little more temporary for some of these dislocations and the price spikes due to that. But rents are certainly moved like crazy, which will go into the CPI. So I think the home prices maybe are starting to cool just a touch, but rents certainly are not. And this is historically kind of the entering into the slower part of the year, and we really haven't seen much pullback. So my kind of current working thesis is we're going to be seeing well above historical norms and rental rate growth all the way through the end of next summer, and probably next fall is when we're going to start seeing a pullback in rental rate growth. And that's kind of I don't see it slowing. And maybe that's a guy from Texas, and maybe if you're in Kansas or something, that's going to be a little bit different. But that's what we're seeing here right now, Paul.
So JP, you're sitting in our seats, and we're advising clients whether to do a fixed rate or do an adjustable rate. And again, lenders, whether it is a bridge lender or it's Fannie Mae or Freddie Mac that is going to offer you an adjustable rate, they're going to want some protection, some insurance in case the interest rates jump up. Again, for folks that don't know, can you get in a little bit of the weeds of what you sell versus, say, if you want to put in the relationship to homeowners insurance in case your apartment building burns down, and hopefully it never happens, but you're buying insurance. Talk a little bit about that.
Sure. You're just buying insurance to protect against a floating rate getting above a certain level that we would call a strike. And these are very common products. And one of the reasons that real estate people love them so much is it's a known number. So you pay for it up front and you're done. Whereas Michael relayed that story of that defeasance or yield maintenance calculation, you don't know what that's going to be on the day that you locked in that rate. And so it can end up being pretty exorbitant down the road. So for most of our customers, they're looking at, generally speaking, sort of 3-ish year timeframes. It's probably the most common. And they're floating either LIBOR or SOFR, which are directly controlled by Fed funds and FOMC monetary policy. So if LIBOR is at 8 basis points today and you buy a cap at 2, you pay $100,000. Nothing happens until LIBOR gets above that strike. And if it never gets above that strike, you never get paid any money back. But to your point, it's kind of like having an insurance contract, hoping you never need it. Because really the best outcome is that LIBOR stays low the entire time that you have this. And it never even comes close to needing any protection out of that cap. So I'm still a big fan of floating rates. What we learned in the last cycle was that the Fed is much slower to move than we think. And you can afford to be patient.
The cost of the insurance goes up exponentially the farther out you go in the hold of the hedge. So if you had a $20 million loan and you were out for 3 years, you would have to come to the table to pay for that hedge one time, $125,000. That's typically, say, what a hedge is, say, today. Now, if you were to take it out 4 years, would be X. If you were to take it out 5 years, it would be Y. And so right now, just to put a little tighter pencil to it, you go 5 years out on a $20 million loan, it's $465,000. So the farther you go out, and you have crystal clear glasses today, but the farther you go out, it becomes more difficult to price into that market. And so that hedge premium cost goes up significantly on that. How far out can you go, JP? Can you go 3, 5, 7, 10 years out? How long can you go out on some of these interest rate hedges?
You can go as far out as you want to go. It's just a matter of how expensive it's going to be. Right. I would say, generally speaking, the longest that we sell is 10 years. And that's almost always exclusively some sort of institutional customer. Generally speaking, I would estimate 80 to 90% of our caps are for 3 years, and almost none go beyond 5 years.
So you buy the insurance for 3 years. Again, we're talking to people that are not familiar with how this stuff works. And so we're peeling back the onion a little bit on this deal with different layers. You buy it for 3 years, but you take out a 5-year term. You have to after the 3 years has been used, you go back in and buy another 2 years. Is that
Yep.
how you do
You got it. But what most of our customers will do is ask for periodic updates once a quarter to say, what would it cost me to buy a cap for the last 2 years? And that way, if something changes dramatically between now and month 36, they have the opportunity to move forward and buy it at that time, as opposed to just waiting till month 36 to buy. They can buy it whenever they want.
And some bridge lenders, which most of their transactions are going to be adjustable rates, are going to require you to take out a 3-year hedge, interest rate hedge. But sometimes they'll let you do 2 years if you think you're only going to be in that property for 2 years, and then put it in the deed of trust that you're going to be required to buy at the end of year 2 another 1-year policy, because again, this is a 3-year loan, so to speak. If you need 1 more year, you can buy it if you don't pay off the loan at the end of the year 2. Is that correct?
Yep, absolutely. And
so that price is going to be a lot less.
A lot less. So I always encourage our borrowers to look closely. What is your actual time horizon for being in this financing? Because if it's genuinely 24 months, I think you should have that discussion with the lender. Are they comfortable with a 24-month cap initially, with the obligation to buy months 25 through 36 if you're still in it? Most lenders are willing to have that dialogue with you and make it a point of negotiation.
Yeah, and the bridge lenders, that's a little bit of a inside baseball scoop of what can and can't do. Again, it comes down to them and what they want to do, but you can ask on if that can be structured, because that could save you thousands of dollars if you do 3-year bridge loan, but 2 years of insurance, hedge insurance, and then figure out if you're going to need it for year 3, if you're still going to be in there for year 3. I'm going to go back to Michael. Michael, are you buying adjustable rates these days? I mean,
yep.
Give me a little bit about you and your view.
Yeah, I became allergic to yield maintenance. Learned that lesson real good. So yeah, we're still floating. I think it's still. I mean, like JP said. I mean, I think even if I can't imagine that they're going to let these the short end of the curve run really long. As soon as the long end goes up, the short end they can be kind of slow and measured. And last time they tapered and then started hiking rates. What do they get up to, JP? I think they did 5 or 6 rate hikes, and they broke the economy in late 2018. So I just think they're just trapped. I don't think they can really ever let these rates really rise in any appreciable way without creating the economy. So I think they're gonna, if inflation starts running, I think they're gonna have to be a little prisoner's dilemma, either let inflation run hot or hike rates and crater the economy. So I think they probably let inflation run hot over cratering the economy with rate hikes. But that's kind of my crystal ball. I don't know if you have any thoughts on that, JP.
Well, what I would add is it's not even that we need to speculate on what we think will happen. We can just listen to what the Fed has said, and they've said we're going to let inflation run hot. And so take them at their word that they would much rather deal with an inflation problem than a deflation problem, because no matter what they tried post-financial crisis, they could not encourage inflation. And so this time around, they've changed their philosophy. This is a huge shift in monetary policy. I know nobody pays attention to it except for nerds like me, but they have this what's called a flexible average inflation targeting, FATE. And what it means is we're going to try to average 2% over the long run, as opposed to hike as soon as it exceeds 2%, which is what they used to do. So in previous cycles, they would already be talking about rate hikes right now, but they changed their philosophy and said, we need to average it. And if we were sub 2% for a really long time, we need to be over 2% for some amount of time before that average. So that, again, convinces me that even if I'm wrong and they do end up hiking a year from now or 18 months from now, it'll be very measured. It'll be very slow and steady. And they're just going to see what is the impact that this has over the long run. Are we bringing inflation back down to 2%? And I think that it'll be a very slow tightening cycle.
Yeah.
Michael, I'll just ask you a little coaching and counseling session here. You buy a property, you put a 3-year bridge loan on it with 2 1-year extensions. You get the higher leverage in the deal versus a typical Fannie Mae or Freddie Mac loan, who looks at these deals underwriting historically versus the pro forma that the bridge loans do. Interest rates rise during the period of time that you're in the bridge loan. You got to take the loan out to pay it off because now you have a maturity coming. Is there going to be a squeeze going on that your next interest rate that you're going to take over is not going to give you the loan dollars you need? What say you about?
Yeah, I mean, potentially, but 20% growth in rental rates will help. So that's what we're seeing now. It's going to cover up a lot of sins along the way. So yeah, I mean, if you can implement, if you're buying something in that scenario, you're probably doing some level of value add to the real estate, and hopefully, increase your NOI through your efforts and trading the rents out at higher rates. I think that, you should have a little bit of margin for error. I mean, obviously, I think anybody prudent that's looking to refinance a deal in the future, you should, estimate having a higher interest rate upon the refinance and, have some sort of sensitivity analysis going on that, hey, at what point can I not refinance out and pay off my existing debt? So, I'm sure most people's business plan would have some level of cash out on that refi too, Paul. So, maybe you suck all your cash out. I guess if it really runs, and it would take, you could certainly find yourself in a problem if JP's wrong and we do see rates kind of run away. I think you certainly find yourself in a problem, but I think that's a relatively low probability from what JP's saying. I tend to agree with.
And then JP, we've asked a lot of questions, but you talk with your customers every day. What questions are they asking that we're not asking here that we should share?
They all want to know where the 10-year treasury will be a year from now. Probably in part for the reasons you guys just discussed. And I think it's more volatile than Fed funds. Like I can say with a high degree of confidence that Fed funds will be below 2% a year from now. I feel far less confident about the 10-year treasury. But what I would say is that if we see the 10-year treasury above 2, it's because inflation caught everybody off guard, right? And if we don't see that materialize, it's going to be really challenging for the 10-year treasury to get above 2%. 175 is kind of the next technical level. And I could see us testing that if things continue to go well in the coming months. But it's not like I can see 3% on the horizon anytime soon. We have to remember that there's nearly $14 trillion of negative yielding debt around the world. And so every time our 10-year treasury ticks higher, it looks that much better than the alternatives. Why would you go buy something that's yielding negative 40 basis points when you can buy a 10-year treasury that's yielding 2%? You wouldn't. And so it just helps keep a leash on our own 10-year treasury. And I think that the Fed is going to want to avoid a runaway freight train because they don't want to see the impact that it has on housing.
Yeah, as we record this, the 10-year treasury is at 151. The Bund on 10 years, negative 0.2. The Japanese 10-year, 0.075 positive. The UK 10-year, 1.0. The French 10-year, 0.14. So, I mean, we're still above everybody, but and I can see why people continue to bring their money to the United States to get some type of rate of return on their money. Michael, any last words to our questions to JP?
This debt ceiling gave a chicken. Do we think that's going to have any sort of impact, or do you think that'll just kind of work itself out?
I'm assuming it's going to work itself out. I mean, there's always that black swan event, but I assume that it'll work itself out. And I mean, this is just ridiculous. Like these guys got to get their acts together and just stop dealing. We do this every year. It's kind of a joke at this point. Just go figure it out and stop messing around with it.
Yeah.
But I agree with Michael about, imagine putting $3.5 trillion more in debt on your balance sheet. How do you pay for that? I mean, that's the biggest thing. You can't have rates rise because that turns around that you have to pay the people you borrow the money from. I mean,
well, but that's the biggest difference between this and COVID stimulus. And that's why there hasn't been the same sort of reaction in 10-year yields that we saw with any sort of COVID related stimulus, which is Biden's plan is basically just taxing the rich to pay for this. And so he doesn't have a plan to issue treasury to pay for that. Now, if that changes, the market will react to that. But that's why the market response on the 10-year treasury yield has been muted around this, is because it's coming out of tax hikes. Now, that starts off another whole debate about GDP and everything, but that's why the market's not puking over it the way it did over COVID, which is this is straight being paid for with Treasury issuance.
I text you, Paul.
It's always
bite your lips, Michael. Bite your lips. No, thanks. Again, any final thoughts, JP, that would be helpful to people that need your services? Tell us a little bit more about if somebody wanted to get more information about what you do, what's the best way for them to do it?
Just shoot us an email or give us a call. We love talking about interest rates. We love answering these questions, having these discussions, and hearing other people's thoughts as well. And so it really doesn't matter if there's a transaction involved. Just give us a shout and let's have a conversation about it, and hopefully we can build a relationship and go from there.
JP would prefer that you had a transaction, not just to shoot the shit to see how he's doing on the East Coast. So we certainly do appreciate JP stepping in. Again, Michael, I have had concerns in the last couple of weeks or so, and I know people that are in a position to rate lock are thinking either way. Should I fix it? Should I float it? If I float it, what are we all talking about here? Is this going to get higher? Am I going to be, have a larger mortgage payment down the road that I should be aware of? And I think JP has done a good job explaining a little bit about where we're at right now. Michael, anything?
No, that's it. I appreciate you coming on, JP. Hopefully your quarterback play gets a little bit better here and the rest of the year, but maybe the Cowboys win the division.
You don't mean that at all. Thanks for having me, guys.
All right. JP Conklin with Pensford. We appreciate it. Michael Becker, thank you very much. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.